There's a headache for the RBA after Australia's CPI indicator rises more than expected in May, and the yen weakens through 160 to the US dollar, its lowest since 1986. That's coming up in our 5 Things in 5 Minutes. And then in part 1 of a bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung analyses recent de-dollarisation, where Chinese banks have cut US dollar liabilities and assets.
The Chinese authority has been pushing for renminbi internationalization for more than a decade. And given the geopolitical pressure, it is very logical for China to quicken the process.
But first in 5 and 5 with ANZ. I'm Alex Tarrant, standing in for Bernard Hickey, who's on a midwinter break this week. US Treasury yields firmed by 5 to 6 basis points overnight, ahead of upcoming auctions and the first round of French elections. Stocks were broadly flat. The US dollar index was up 0.35% at 4 a.m. Sydney-Melbourne time. Despite that, the Aussie dollar was up 0.18% at 66.57 US cents. The Kiwi was down 0.6 at 60.82. The Aussie strength followed stronger than expected May CPI data, up 4% from a year ago. ANZ's senior economist, Catherine Birch, says there are indications that non-tradables disinflation stalled and services inflation picked up.
The stronger than expected print was driven by smaller falls in clothing and footwear and fuel prices. We saw prices for fruit and veg and international holidays actually rise instead of falling. Rent and alcohol and tobacco inflation was a touch stronger than expected, and some of this was partially offset by weaker than expected electricity and gas prices.
Number 2. Catherine says the result could make the Reserve Bank of Australia a little nervous.
It does increase the risk that the Q2 CPI will overshoot the RBA's forecasts. And there is a scenario if this occurred alongside upward revisions to the RBA's expectations for things like activity in the labour market. It is possible that the RBA could lift the cash rate, although a rate hike is not our base case. But we also have to keep in mind that the US recently went through a bit of a stalling in the disinflation process early this year, and they seem to be coming out of that now, with disinflation resuming in April and May.
Number 3. Ahead of the CPI data, RBA Assistant Governor Christopher Kent gave a speech reiterating the central bank's view that monetary policy was restrictive.
The Assistant Governor said that the effects of those tighter monetary policy and more restrictive financial conditions are being felt most directly by households, particularly the around 40% of Australian households that have a mortgage. And we're seeing that show up in the weakness in spending, but also the fact that we are seeing people sort of add their payments into offset and redraw accounts because it makes more economic sense. The incentive is to save rather than borrow at the moment.
Number 4. The yen weakened to 160.62 to the US dollar overnight, its lowest since 1986. Authorities noted concern with the rapid weakening and threatened action against, quote, excessive movements. Eyes are now on how the interest rate gap between the US and Japan will be affected by reaction to Friday's US PCE data. Here's ANZ FX analyst Felix Ryan.
For dollar yen to head higher, such as 165 or even 170, a wider US-Japan yield differential would help, especially if we get fresh signs that Fed easing is unlikely to happen in the near term. We do note, however, that dollar yen is also exhibiting quite strong correlations with dollar yuan and other Asia currencies more broadly, suggesting that in part the yen's weakness is reflective of the general softness of Asia area currencies against the broadly firmer dollar at the moment. Intervention is still a risk for dollar yen, but what the Ministry of Finance do look at is the speed as well as the level of depreciation in the yen.
Number 5. The Philippines Central Bank is expected to keep its main policy rate on hold at 6.5% today. ANZ economist Arindam Chakraborty says inflation has risen for 4 months in a row to near the top of the BSP's 2 to 4% target band.
With favourable base effects fading, annual inflation may continue to accelerate in the near term and even breach the 4% upper bound of the official target range. Therefore, we believe the BSP will maintain a hawkish bias and will wait until the headline inflation moves towards the midpoint of the 2 to 4% official target range. We do not anticipate a policy rate cut in 2024.
Arindam Chakraborty there. Now in part 1 of a bonus deep dive interview on China's de-dollarisation, ANZ Chief Economist for Greater China Raymond Yeung outlines how and why Chinese banks have been cutting US dollar liabilities and assets.
For the asset size, the US dollar holding has down by around 22%, and the liability size been down by 32% from the peak in the middle of 2021. And we also see that apparently the cross-border transaction in China is already renminbi or local currency denominated. It used to be the US dollar represent a high proportion of the cross-border flow, but it's now the US dollar transactions in down by below 50% now. So apparently there's been a lot more renminbi cross-border flow through not only the current account transaction, but mostly the capital account transaction because of the different financial flow through the onshore, offshore, stock market connects and bond connects and different type of portfolio connects between Hong Kong and the mainland. So apparently the Chinese external transactions are increasingly using local currency, and the dollarization process seems to be quickened in the past 2 years.
Why do you think that is in terms of those cross-border flows? Is it a macro reason or potentially political reasons?
There are two reasons. I believe first of all is the cyclical reason. Because of the high US dollar interest rate in the past 2-3 years, then it is very logical for Chinese entities. Most of them are exporter or importers, so make use of different financial products by settling the amount in the renminbi because of the relatively cheap cost of funding onshore, and to have got a lot more US dollar asset in the offshore market, but the transaction and the settlement itself has been done in renminbi. So that's increased the share of the renminbi in the cross-border flow. Secondly is obviously from a variety of reasons, then China also really want to boost their local currency transaction as the economy has been growing to be a second largest economy, and the Chinese authority has been pushing for renminbi internationalization for more than a decade. And given the geopolitical pressure, it is very logical for China to quicken the process so that they can, on one hand, continue to deal with the rest of the world, but on the other hand, they really want to deal with it with a financial security. So this is, I believe, to be a kind of logic for China to push for the renminbi internationalization and reduce the US dollar holding.
Raymond Yeung there. I'm Alex Tarrant, standing in for Bernard Hickey. That was 5 and 5 with ANZ for Thursday, June the 27th. Catch you tomorrow with part 2 of Raymond's Deep Dive, looking at why China is pushing for greater monetary independence.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.